ourselves, okay, well, all we're going to do is look at the high and the low, and that's all that matters. Because I'm never teaching trading in this consolidation to get to just this level. That's too small. It's too myopic, and you're not going to do well if you're just looking at it like that. So what are we supposed to be doing? Well, you got to come off that 1 minute chart and go at least up to a 15-minute time frame. So with a 15-minute time frame, you can see that we had relative equal highs here. So that was an obvious level to do what? Anticipate price wanting to clean up this area up in here. So just like we have here, there, and we had sell side there. Now, while it's moved up here and we've moved sideways, inside this pre-market opening before 9:30, we were in this small little range, which was part of this consolidation here. What is it more likely to do if you had control to steer price with the expectation of knocking out other traders so that way you could take their position over where they get out with a loss? Where they get out with a loss, your intentions are to take that trade over exactly where they get out. Understand that these markets operate on the basis of liquidity. They seek yield, and they like to reprice to cause efficiency where there's inefficiency. When you take a step back and you look at it from that perspective, it makes things so much more simpler. Because wherever the maximum pain is, that's the path of least resistance for price. What does that mean? Because we moved off that 1 minute chart, a bellwether time frame for me is 15 minutes. Okay, so if I'm looking for something that is liquidity based, where I'm looking for a draw on liquidity that's going to have an impact for the session. I'm not talking about an hour candle where I can trade inside a 1 hour candle and I can get a scalp and I can make what an average person can earn in a week with every single 1 hour candle. I don't need to do that. You shouldn't try to do that. But for the sake of understanding the highest degree of probability where the market's going to reach for, you have to come off that 1 minute. You got to come off that 5 minute, go to at least a 15-minute time frame. Why? Because the majority of short-term fluctuations that's going on in intraday algorithmic price delivery is on that time frame. Now, I'm going to say it in simpler terms. The liquidity you're looking for as a general go-to that's going to serve you the best is a 15-minute time frame chart. That's the ones that are so clear and they're obvious. They don't hide them from you. They can never hide them from you because this is the first one they work off of. When we're